Welcome to Policy on Demand. I am Noha Nayeri. Last week, the IRS and Treasury issued interim guidance on the corporate alternative minimum tax, which we will refer to today as CAMT. The guidance was related to insurance-specific issues. And today, I am joined by Geroge Manousos and Mark Smith to talk about what was included in the guidance and what to expect next. Geroge and Mark, welcome.
Thank you. Happy to be here.
Thank you. Good to be here.
So, Geroge, maybe before we get to the details with respect to what was included in the guidance, I'll start with you first. And just can you help level set what was the guidance issued to date on CAMT?
Sure. So back in December, the government issued Notice 2023-7, which was the initial CAMT guidance that addressed some issues in the areas of M&A transactions and the AFSI depreciation adjustment. However, the government has continually said that we're going to have two or more notices that would be forthcoming. One would address insurance-specific issues, and then a third notice addressing a variety of other areas. Notice 2023-20 is that insurance-specific issue that Mark will talk about in a moment. And then we'll wait for the third notice that will address a broader array of issues.
So, Mark, now we'll get into the details. And can you tell us what was included in the guidance that was issued last week?
Sure. The notice is about insurance-specific issues. A significant number of companies that are affected by the CAMT are insurance companies, and the notice's purpose is to prevent significant adverse unintended consequences to those companies. So the first issue that's addressed is basically the accounting for variable life insurance and annuity contracts and similar contracts. Basically, under a variable life insurance or annuity contract, the benefits under the contract or the premiums paid depend on the investment performance of a pool of assets. So under the CAMT, unrealized gains and losses generally are not taken into account. However, for a life insurance company, reserves do take those gains and losses into account, and those amounts are tax deductible. So the purpose of the notice is to prevent distortion, and the approach of the notice is to adjust the corresponding amounts, the reserve amounts, rather than the unrealized gains and losses on the assets. The second issue that's addressed in the notice is accounting for reinsurance transactions. Run-of-the-mill co-insurance transaction, the insurance company pays assets to a reinsurer to assume risks under insurance contracts. For funds withheld and modified co-insurance, the ceding company, we refer to the insurer as the ceding company, retains the assets, but records a payable to the reinsurer that in part reflects the gains and losses on those assets. So again, you have this potential for distortion, where on the one hand, the gains and losses are not taken into account. On the other hand, the changes in that payable run through net income. And again, the approach in the notice is to correct that distortion by adjusting the corresponding item. The third issue that's addressed in the notice is the fresh start for a handful of companies that were made taxable in the 1980s and 90s. Basically, the approach of the notice is to preserve the fresh start basis that was given to those companies when they entered the tax system. And those companies are identified basically by name or by class in the notice itself. The notice requests comments. The comments are due April 3rd. And basically, companies are still digesting what is in the notice.
And Geroge, the last question is to you. You have mentioned earlier that there was additional guidance that we're expecting. What do you think will be included in that guidance, and what is your expected timing on that?
Yeah, great. The third notice is supposed to be the big notice, right? It's supposed to address a variety of areas, most importantly international, because we don't have any international guidance yet. In particular, the so-called double counting issue, as well as guidance on foreign tax credits. Also partnership issues. We don't have any guidance on partnerships. How is partnership share income taken into account for applicable corporation status? And most importantly, how is the government going to define distributive share? And then we're also going to expect some guidance in the areas of how do things like OCI, other comprehensive income, or book mark-to-market adjustments or unrealized gains and losses, how are those going to be taken into account, or are they taken into account in determining AFSI? Now, the government has continually said that we can expect this guidance by the end of the first calendar quarter, so by March 31, because they want the guidance out so companies have that guidance in time for their first quarter financial statements, as well as their first quarter estimated tax payments. Now, after that, I think we're probably looking towards proposed regs. The government hasn't said anything more about future notices after this third big one that we're expecting. So I'd expect sometime probably later spring, we'll get proposed regulations that will incorporate all the guidance in the notices, as well as additional issues that they haven't addressed yet.
Well, George and Mark, thank you so much.
Thank you.
My pleasure. Thank you.
And to our viewers, as always, thank you for spending this time with us, and we'll see you next time.